What up, traders? What up, investors? Ken here from Dyslexic Investor, and thank you for tuning in for another fantastic video. Yes, the market has been not fun in a lot of categories that we can look at. We're going to be looking at the smorgasbord. We're going to be looking at the full rainbow. We're going to be looking at the market, really particularly the Nasdaq, which again a lot of people derive from more the heavy, faster growth stuff, and the one that really has been very robust, and the one that's really been beaten down. And kind of looking at what we're looking at, what we could be projecting, and just looking at some potential trade ideas and different things that can come forth. But I wanted to highlight this one thing that came out just a little bit ago on the 8th of March. Again, if we're going to be jumping to the Nasdaq on the 8th of March and really what happened. David Tepper, you might know him as the football owner for the Carolina Panthers, but he also runs a very efficient and very profitable fund management company, hedge fund basically, and he has gone on CNBC, not directly, but has emailed the correspondents and the talking heads on CNBC saying, hey, I'm bullish on the market and I believe rates are set to stabilize and go higher here. So why does he say that? Why does he have that confidence and just say, yeah, it's going to be just fine, going into the nitty-gritty of the 10-year yield on the rate of decline of the 10-year yield and not where it's currently sitting? I think many new investors are not used to the skew, especially once we jump into the charts. You'll see the growth from basically the beginning of November to the high that we saw early this year of nearly 27 to 26% in about little over 3 months. That's a very insane amount of return in a very short period of time, and it's a very popular saying. You hear the saying a staircase up and an elevator down. Like we've pulled back 12 to 13% in the last 2.5, 3 weeks almost, and really giving half of it, at least, of that back. So with the bond yields and the treasury yields is what we have to identify here of, okay, is there a disconnect between the bond market and the treasury yields? That's basically what Tepper is talking about. It's like they only can go up so fast, but really what the course of action, what we need to focus on is the interest rates of that. So what I mean by that is the Fed. So the Fed has come out and said that they're not raising any interest rates and have looking at the inflation limits. Again, they're saying everything's nominal, everything's fine. The little bit of bounce that you're seeing here currently, we do have the tools to put into place if we do see that inflation coming out. But they've said in their Fed minutes and their speeches that we're not looking to raise interest rates until 2023. I was like, okay, all right. I had to check with a couple people on the Discord. I had to double check everything and make sure I heard and read that right. I seen that pretty impressive. So let's just see how that unfolds. That's basically what we need to look at. We need to see on how the Fed will continue to react to the potential claims from the yield curve folks on if interest rates are going to be kind of coming back here a little bit. Of course, if we have inflation getting out of control of well over above 2%, that's going to start affecting the market. Again, Tepper has talked about multiple times on how the different effects, kind of the wave effect hits. Okay, it hits bonds go crashing down. Okay, then you have the fear of inflation that will affect some of the higher growth market caps for companies that need to can potentially are driven on revenue growth. Of course, with inflation going higher, it causes a lot of effect on higher rates, borrowing costs, the lack of liquidity in the sense of finding a stable market when you have inflation going through the roof, not like hyperinflation in the sense like we saw in wartime zones where a loaf of bread could cost you like 250 Deutschmarks and things like that. That's going to be the extreme end, but just any kind of inflation counteracting with the growth that we're seeing in the reopening plays is a very tight rope that needs to be walked and very heavily monitored because of that. On that note, we of course have 1.9 billions money being added into the market, of course, via the stimmies, as they call it. That's going to be a lot of money, and that has already seen quite a many people get their checks. On the other note, we're just going to be looking at. He did comment also on this article, and there wasn't an interview. He didn't come on CNBC or the phone. He just says the hedge fund manager, of course, that Tepper is basically saying stocks like Amazon are starting to look very attractive here after the pullback. The shares of the e-com giant blah, 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 has falling these lows. Of course, we'll look at Amazon as well once we jump into the chart. So looking here, the charts are going to be looking at QQQ. That's the Nasdaq index. Of course, he came out on the 8th of March. That was basically the day after we saw the low in the previous move higher. So then now we're kind of just still seeing that chop. So I've posted multiple charts on Twitter, via the Discord as well, on just like, hey, we are in this consolidation zone. If you're a trend follower, if you're a little bit more longer mindset, this could be a time to acquire the stocks you really like that can potentially looking at. But idolizing and looking at, be very mindful of those very heavy growth stocks or potential growth stocks. I call them potential growth stocks because they really don't have, they're kind of built on like hopes and prayers kind of thing, where they're just kind of, we have a product and we think that we're going to be making this much money, and we did multiple offerings to kind of gain capital to potentially buy companies. So you have to be very careful here on a lot of this. I'm really kind of highlighting the SPAC. So I'm being very careful on how I word it. You have to be very mindful potentially of how the SPACs have affected in a lot of this market here. Okay, going back to the QQQ here, you do see that low kind of coming in here. On the QQQ, we're going to be looking for basically 300. 300 is the level, of course, great movie, but also a great level of very, very strong support. And since this is it's not a crash like a lot of people have talked about, of just like, oh no, my hair's on fire, it's crashing. It's a correction, okay? It's a really just kind of wiping out a lot of people, and it's sad that it happens, but this is the market that we trade on. This is the market that we play on. You have to know the circumstances of what happens when you play these certain markets. And buy the dip, bro, doesn't always work. So I want to really isolate that. Normally, if we do get a pretty strong pullback, again, if you just have just traded the market, if you just started to look into investing and you just got into the market in November, so kind of just looking at the last like somewhat of a market move down that we've had, which is basically the beginning markings of November of last year, so 2020. So from the low of November 2020 that we saw, that last little market pullback was nearly a 10, almost 11%. And then from that bottom, around the 89 EMA, which is that blue line here, we saw a nice rocket ship higher into the second week of February at 26.68%. Okay, so that was about 106 days to build up nearly 27%. Then at the same note, of course, that goes back into the very famous trading saying, a staircase up and an elevator down. And then on that very high note to the downside, Thinkorswim didn't do it again. I tell them they got to update that. From that high to the bottom that we saw on the 5th, actually, excuse me, is nearly 12%. So 12% in 18 days is like 0.75, 0.8% a day down on average. And that's a very aggressive move. In 18 days, you've dropped 12%. So that's a lot. That's very much. That's a lot of percentage. And now we're just kind of sitting like, holy moly guacamole mode of like, what's going on here, and how are we going to be able to bounce back from this? Again, the market is not a nice tame beast. It can rip your head off, aka the bull and the bear acronym. looking at this bounce here, of course, bounced very hard off here. Not saying David Tepper was right, which I do believe he was right, in calling it in the, I believe, a short-term bottom. You never know what can come out tomorrow or the next day if the government does this or new strain of virus comes out or whatever. It can kind of really affect quite a few things. So as of right now, on 3/25/2021 at 4:12 p.m. here Eastern Standard Time, I believe that this is a short-term bottom around 297 on the QQQ. Meaning short-term bottom, if we do get more information and selling off, we could really easily break through that. Initially speaking, if we're looking at the pattern of a sell-off, so we're going to be looking at some history again. History doesn't repeat, it rhymes. So if you remember, if you have been trading in the same time frame, basically last August into September, that we had a 14% pullback, okay? 14% pullback in 19 days, okay? In 19 days. That's a very aggressive pullback as well. Of course, the market has been very substantial due to the market's moving fast, information getting out, and just being disseminated across multiple platforms, and people are able to trade it almost instantaneously. Many years ago, even though we had the internet, it was fantastic. It still took a couple hours to kind of have the flow go through and people get very then make the decision. But now it's so quick and fast, and that's why we're seeing always these very aggressive pullbacks and really fast rubber banding bounce back as well. So that it goes both ways. And at the same note, it wasn't a complete V-shaped recovery, bro, where it just kind of just continues going back higher and it's like it just never happened. It normally kind of comes back, potentially gets kind of close to where it was, and then gets another little rickshaw rubber band higher from there. I don't know why I said rickshaw. What is that? It kind of like rickshaws off the back of the moving averages and kind of jumps off from there. I don't know what the hell I'm saying on that part. I don't know where rickshaw came from. Anywho, so going back into what the current market's looking like. The IV, everything has been pretty much beaten down in the Nasdaq. People are hurting. That's what the market wants to do. It makes almost like it creates a self-destruct kind of button or a burn, and just kind of burns any kind of potential, again, weak hands, bro, scenario, and it allows the people who've been around for a while, understand the potential market, to start building in position. David Tepper talked about Amazon, of course. So jumping into Amazon, I believe as well. I love me some Amazon. I think it's great. Again, we're not going to be going into the political realm of their Alabama unionization, but again, that 3/8, so March 8th? Yeah, March 8th. My throat's dry, sorry. So 3/8, seeing that pretty strong bounce back. Still very choppy, almost looking exactly like the Nasdaq. So with the Nasdaq actually just closing just a little bit lower today, but we are slightly above the 89 EMA. So we do have some short-term support at 305, like we talked about. 300 or the 144 EMA is a pretty significant line in the sand. If that does break through it, that could really open and break down the dam that's holding back some of the bears, and can really kind of explode things. That's of course if we get a pushback of higher rates sooner, which again is on the table. I think that the current market is not putting that in the projections. I think right now, especially with the Nasdaq trust or the Nasdaq ETF, it's just been very hit and miss. It's really just kind of rebalancing, burning itself, getting at those weak hands, and the potential buyers are coming in on these low days around the 89 EMA potentially. In the short term of that, so we're looking at a little bit more finite short-term side. If we kind of go out to the weekly side, guess where that 89 leans up? Comes down to 21 EMA on the weekly side. Really like to see, again, look at this astronomical amount of move. From the bottom of last year to the high, we are up 105%. 105%. So if I put in just one stock of QQQ at basically 175 and I sold at the very top, I doubled my money. Like, that's insane in 1 year. It's very strange times. And I want to highlight folks and tell folks that this is not the most normal spec in the market. Again, stocks just don't continuously go up on fluff, on the different things. So I think certain people have to reset their mind and reset their senses in the market. Again, I think in long term the market's going to be just fine, creating the bullish consensus that I believe in, especially being a U.S. citizen and believing in America, that we're going to get through this, everything's going to be fine, blah, blah, blah. In the short term, yes, I think we're still going to see chop, chop, chop. Chop, chop, chop. What does that mean? We're looking for those levels around 321 to 305 to basically potentially bounce around. Of course, what are we going to be looking at? The interest rates, the yields, what the Fed is saying, and so forth. The Fed is currently saying they're keeping an eye on the inflation due to job growth and the reopening plays. So the reopening plays are very large component. You're seeing it run quite a bit in the reopening of whatever. Like the one I just commented on a couple people on, where was it? Have you seen SeaWorld? SeaWorld? What? Look at this. Look at this thing. And this thing is gangbusters. This was $6.75. That's when everyone thought SeaWorld is done. Ship the animals back to the ocean. No more cheesy fries for you, Fred. We're closing down SeaWorld. It's going bankrupt. No. It made an about face. It's trading at $52 now. $52. A year later, it is trading at $52. Absolutely insane. Talk about just the fight, the will. I can go on and on. There's so many different examples. AMC. I know people love AMC. I don't know why I keep on slapping like this. Like it just means like authority. Like just boom. I need like a hammer or something to pound the table. AMC. Same scenario. This was trading at $1.91. Of course, Wall Street Bet, folks. Of course, we're not going to go to GME because that's in a whole different universe. But AMC. Holy moly guacamole. Like, it got up to $20, but that was, again, a lot to the short squeeze, but that's rebounding very well. And that was very much a really heavy hit business, even previously due to a lot of financial issues. But this was almost a godsend and be able to raise capital here. So I want the people to reset their minds, to relook at the senses of what is the new normal. And look at, okay, in the year past, that was fantastic, right? That was a fantastic move. Will it come back again to that level? I would say yes, but statistically speaking, probably not. But we continuously could see the bull run continue due to the reopening plays, a lot of money being stemmed on infrastructure potentially, and the rebuilding and the reorganizing of getting back to normal. So on that fact, I just want to thank everyone for coming out and watching. And if you haven't already, hit the like and subscribe, and I'll catch you guys on the flip side. Peace.